Hi everyone, welcome back to the Investing Iguana, where we talk about all things finance and investing. I'm your host, Iggy, and today we have some exciting news to share with you via my usual 10-minute short podcast video. One of the biggest banks in Singapore and Southeast Asia, DBS Group, has just announced its second quarter results for 2023, and boy, are they impressive. DBS Q2 profit beats forecasts to rise 45% to 2.6 billion Singapore dollars, declares 48 cents dividend. That's right, folks, DBS has smashed the analysts' expectations and delivered a record-breaking quarterly net profit of 2.69 billion Singapore dollars, up from 1.82 billion Singapore dollars a year ago. That's a whopping 48% increase year-on-year, or 45% if you include the integration costs of acquiring Citigroup's Taiwan consumer banking business in Q2. So what drove this stellar performance by DBS? Well, there are a few factors that contributed to this amazing result. First of all, DBS benefited from higher interest rates in the second quarter, which boosted its net interest margin, NIM, a key measure of how profitable a bank is. NIM is basically the difference between the interest income a bank earns from lending money and the interest expense it pays to depositors and other creditors. The higher the NIM, the more money a bank makes from its core business of lending. DBS's NIM rose for the sixth consecutive quarter to 2.81%, up from 1.85% a year ago and 2.69% in the previous quarter. This was mainly due to unexpected U.S. interest rate hikes in the second half of 2023 and a rise in the Hong Kong interbank offered rate, HIBOR, which are both benchmarks that DBS uses to price its loans. DBS also said that it expects its NIM to continue to grow in the second half of the year, as 1/5 of its commercial book has yet to reprice and it faces lower deposit repricing pressure than it had anticipated. Another factor that helped DBS achieve record profits was the growth in its non-interest income activities, which include fees, commissions, trading income, and other sources of revenue that are not related to lending. DBS's total income for the second quarter crossed the 5 billion Singapore dollar mark for the first time, reaching 5.1 billion Singapore dollars, up 40% from 3.7 billion Singapore dollars a year ago. Of this amount, 3.6 billion Singapore dollars came from net interest income, which rose 54% year-on-year, while 823 million Singapore dollars came from net fee income, which rose 7% year-on-year. DBS's net fee income increased for the first time in 6 quarters, mainly driven by higher wealth management fees, which rose 12% to 377 million Singapore dollars, thanks to higher sales of bancassurance and investment products. Bancassurance is when a bank sells insurance products to its customers, while investment products include things like mutual funds, bonds, and structured products. DBS also saw growth in its card fees, which rose 9% to 205 million Singapore dollars, as consumer spending recovered from the pandemic-induced slump. DBS's trading income, however, declined by 13% to 507 million Singapore dollars, as lower treasury markets income offset higher treasury customer income. Treasury markets income refers to the income that DBS earns from trading financial instruments such as currencies, interest rates, and commodities for its own account or on behalf of its customers. Treasury customer income refers to the income that DBS earns from providing hedging and risk management solutions to its customers. DBS's expenses for the second quarter rose by 16% to 1.9 billion Singapore dollars, mainly due to higher staff costs as it hired more employees and paid out higher bonuses and incentives. DBS's cost-to-income ratio, which measures how efficiently a bank manages its operating costs relative to its income, improved by 6 percentage points to 38%, indicating that DBS was able to generate more income for every dollar of expense. DBS's asset quality also remained stable in the second quarter, as its non-performing loan, NPL, ratio stayed unchanged at 1.1%. NPL ratio is the percentage of loans that are overdue or unlikely to be repaid by borrowers. A lower NPL ratio means that a bank has fewer bad loans on its books and less risk of losing money from defaults. DBS's return on equity, ROE, which measures how well a bank uses its shareholders' money to generate profits, hit a new quarterly high of 19.2%, up from 13.4% a year ago and 18.6% in the previous quarter. This means that DBS was able to earn more money for every dollar of equity invested by its shareholders. DBS also declared a dividend of 48 cents per share for the second quarter, up from 36 cents per share a year ago. Together with the first quarter dividend of 42 cents per share, DBS's total dividend for the first half of 2023 amounted to 90 cents per share, up from 72 cents per share in the first half of 2022. DBS said that the increase in dividend reflects its stronger earnings prospects for the year and its confidence in its capital position. So what does this all mean for you, the investor? Well, if you are a shareholder of DBS, you should be very happy with these results, as they show that DBS is a well-managed and resilient bank that can deliver strong and consistent growth in a challenging environment. DBS's share price has risen by about 20% since the start of the year, outperforming its peers and the broader market. DBS is currently trading at around 35 Singapore dollars per share, which gives it a market capitalization of about 90 billion Singapore dollars and a price-to-earnings (PE) ratio of about 14. A PE ratio is a measure of how expensive a stock is relative to its earnings. A lower PE ratio means that a stock is cheaper or more undervalued. If you are not a shareholder of DBS, you might want to consider adding it to your portfolio, as it offers a combination of growth, value, and income that is hard to find in today's market. DBS is not only the largest and most profitable bank in Singapore and Southeast Asia, but also one of the most innovative and digital-savvy banks in the world. DBS has been investing heavily in technology and digital transformation, which has enabled it to enhance its customer experience, improve its operational efficiency, and create new sources of revenue. DBS has also been expanding its presence and reach in key markets such as China, India, Indonesia, and Taiwan, where it sees huge potential for growth and diversification. DBS has also been pursuing strategic partnerships and acquisitions to strengthen its capabilities and offerings in areas such as wealth management, insurance, payments, and sustainability. DBS's CEO Piyush Gupta said that while there is some macroeconomic uncertainty due to the COVID-19 pandemic and geopolitical tensions, he is optimistic about DBS's prospects for the rest of the year, as it has a proven ability to capture business opportunities and adapt to changing customer needs. So there you have it, folks. That's my take on DBS's second quarter results for 2023. I hope you found this podcast video informative and entertaining. If you did, please give it a thumbs up and subscribe to my channel for more videos like this. And don't forget to hit the bell icon to get notified whenever I upload a new video. Also, let me know what you think about DBS in the comments section below. Do you own DBS shares? Are you planning to buy or sell them? What do you think are the strengths and weaknesses of DBS? I would love to hear your thoughts and opinions. Thank you so much for watching the Investing Iguana. I'm Iggy, signing off. Until next time, stay safe and happy investing.